Hey guys, welcome to The Syndicate, the show where we get the world's best angels, VCs, and we don't touch startup founders because everyone else does that on the podcast. Today we've got a fun one, Jonathan Nelson. So Jonathan is an interesting guy. He's got a ponytail, a beard, got called before the SEC to help them a little bit. And he's building a massive fund, has one of the largest networks of founders around the world, and is an all-around pretty interesting and fun guy. Thanks for coming today, Jonathan.
My pleasure. Great to be here. Thanks for having me.
So I gave like a 10-second intro of you. Can you tell me how you got into this world?
Through the back door. I was working as a nurse and I decided to go back to school for software engineering and learn how to be an entrepreneur. So I moved to Silicon Valley and was working at a hospital managing 700 people. And then 4 nights a week, my plan was to code and learn how to be an entrepreneur. And along the way, it was actually my wife's idea because I was talking startup. And my wife was, honey, I love you, but please just get out of the house 1 night a month. Go to a bar, talk to somebody else about startups. No, honey, you need to build your business network. So I started this meetup called Hackers and Founders, and our first event was 5 people and me in a bar. And it was in Sunnyvale, California at St. John's Bar and Grill. And the next month, the meetup was 8 people. And the next month, it was 13 people, and then 23, and then 35. And pretty soon, instead of every month, we had to do it twice a month. And then people in San Francisco wanted us to hold the event there. So we started going to every week and doing it different places around Silicon Valley. Fast forward 10 years, our events kind of went viral, kind of like entrepreneur support groups. And they've been held in about 120 cities around the globe, and several 100,000 entrepreneurs have attended our events. And holy crap, what do you do with that? We eventually ended up, I quit nursing 5 years ago.
Only 5 years? Are you serious?
Yeah.
Interesting.
I did double duty for a number of years just because I was bootstrapping. And, you know, I mean, when I came into startup land, I was having a background in healthcare just gives you this weird perspective. And so I was looking for like academic studies, like data, like research, like, you know, medical quality research on what best practices are to actually build a startup. What are my chances of survival? What are our morbidity and mortality rates for entrepreneurs? And everybody's like, oh, they're terrible. I'm like, well, what do you mean terrible? Like, well, it's only 1 out of every 10 startups succeeds. Like, you'd better off staying a nurse, Jonathan. I'm like, but wait, 1 out of every 10 startups succeeds? Does that mean survive? Does that define success? Well, it's 1 out of every 10 companies tends to return a VC's portfolio. I'm like, wait, okay, what does that mean? Well, you would give the VC a 20 to 50x return on the original investment. I'm like, wait. So these are professionals, yeah. And only 1 out of every 10 patients that they take on, they consider a win, and 90% of their patients die. Like, can I call medical malpractice in investment? Like, how does that work? Because my definition of success as an entrepreneur is a lot different. Like, I want to have a profitable company. I want to have employees. Oh, no. We call those zombie companies in Silicon Valley. Like, what? Like, this is crazy. Why? And so it was that why, and this is crazy, that kind of led me into, and conversations with literally thousands of entrepreneurs hanging out at Hackers and Founders events, that just kind of led me to try and develop solutions to these things and to these problems that to me were just kind of screaming that needed solutions. And so that eventually ended up to us leading to build a different kind of fund. to serve kind of the capital needs of the entrepreneurs from around the globe that we're actually meeting and talking to, and that we hear them complain about pints of beer at a bar over what their challenges are. So it's all about entrepreneurs complaining over beer and helping each other out.
Everything comes back to beer. So tell me, how do you run a 300,000 person? It's not like 300,000 consistent people, but no, it's still a massive organization. How do you manage something like that?
You know, so again, my background's a little bit stranger. Daddy was a preacher. I grew up, my parents were missionaries, and their job was to build communities of believers. And Dad started in Costa Rica, where I grew up. The team that they were with started 60 churches in 10 years. I dropped out of seminary, but I was just kind of born and bred with, you build communities of believers. And my mental model is that tech entrepreneurship is something of a techno religion. Like, we get together at an event in a bar. We don't have wine and bread. We have beer and, fries, or beer and sandwiches. And we share our similar beliefs that we can change the world through technological innovation. And essentially, we started like little kind of similar communities, pockets of believers around the world. And it was kind of like shooting fish in a barrel for me, just because that's how I grew up. But I was, as I said, I came to this thing through the back door. But it's essentially, for me, I was learning about startups and entrepreneurship through the internet. And I was spending all my free time coding in front of the internet. And being able to get together in a location and share experiences with other entrepreneurs, it was like this religious experience. It's like, oh my gosh, you too? Holy crap. And you have this connection and this bond. And people wanted to be able to develop that kind of community back home. We're Silicon Valley. It's kind of Mecca, as it were, for entrepreneurs. People from around the globe in 2009 and 2010, when the global economies tanked, you had a lot of underemployed engineers who started building things. Sometimes those things evolved into products. Sometimes the difference being that someone will buy your product. No one wants your thing, but someone actually wants your product. And then sometimes those products start selling quickly. And if I'm in, Bucharest, or if I'm in Buenos Aires, or if I'm in Guadalajara, Mexico, and I have a tech product that's selling quickly, well, obviously I have to go to Silicon Valley, right? And go to Mecca and, do my pilgrimage and, walk around the Google campus 7 times and figure out how this whole startup money thing works. And so these people started coming from around the globe. They would end up at this meetup. They would say, hey, Jonathan, this is a great event. There's 200 people in this bar, and they're all tech entrepreneurs. Holy crap. Like, hey, how do I raise $5 million? I'd be like, yeah, I don't know, dude. I'm a nurse. What? What do you mean you're a nurse? Like, this is Hackers and Founders. Well, in my spare time, I'm building a search engine for financial news coming out of emerging markets. What? Well, I'm kind of a finance nerd. I'm the software engineer, and, I code 4 nights a week, and I work at a hospital 3 nights a week. And they're like, okay, this is really weird. I'm like, here, have a beer. Let's talk. What's going on with you? And I started seeing this massive problem of all of these entrepreneurs, just desperately wanting kind of to build community and to be able to help each other out in kind of a Linuxy sort of open sourcey kind of way. Open source software we share, we give our code to each other, we help each other out. In entrepreneurship, the best parts of this entrepreneur community, we share, we give, we help each other out, we collaborate, we don't, we compete, but it's not directly competing against each other, like I need to kill your company, your startup. At the early stage, it's much better off, let's just help each other out. And you can kind of shape that into, if you have a believer who decides to start a similar community of belief and support and collaboration in Guadalajara, Mexico, as Mac Gutierrez, our director in Mexico, did. Guadalajara 6 years ago, there were 2 startup events every month. Guadalajara has more engineers than all of Ireland. Go figure, who'd have knew it? At this point, I believe they have anywhere between 20 to 30 startup events a month in and around Guadalajara, Mexico. And so there's this global explosion in tech entrepreneurship. A lot of people are realizing that if I have a laptop and an internet connection, I can play the game. But a lot of us are just kind of alone doing this in front of a laptop and building a community around that and supporting the community. It's not easy, but it's also just kind of giving people what they want and helping them build what they need and encouraging them and saying, why not? And honestly, the vast majority of Hackers and Founders events are just run by volunteers. People kind of took it in a Linux sort of fashion. We've taken an open source approach to the brand. As long as people agree not to be assholes, not to fuck up the brand, and not to do the right thing for startups in their community, they can essentially have a license to Hackers and Founders events. And then, frankly, I learned from them about what startups need and the problems that they have in their region. And that's really how we built this massive kind of messy network of people running Hackers and Founders events. And I've been kind of scratching my head saying, what the hell do we do with all of this? I really wanted to be a software engineer and an entrepreneur in the software space, but there's all of these entrepreneurs who have these screaming problems, and they became our customers, and we just started building solutions for tech entrepreneurs. 5 years ago, we turned it into a business where we would help tech entrepreneurs land in Silicon Valley from overseas. We take an advisory stake, a significant advisory stake in the company, and then we just work with the company for as long and hard as we can to help the company land, to help them raise, to help them deal with immigration, with banking, with legal, with regulatory problems, with hiring. We've actually developed the program so that I have a concierge physician on call. I pay him $5,000 a year, because I've had friends of mine come here from overseas without health insurance. They get sick, they go to an emergency room, they end up with a $30,000 emergency room bill, and all of a sudden the company's in crisis and maybe shutting down because they couldn't get a doctor. So I just said, screw it, I'm going to hire a boutique physician. And I text John Made, Dr. John Made, and he texts me right back, and he will see my CEOs within same day or within 24 hours, and he charges $100 as a flat fee. And I can keep my entrepreneurs, my portfolio companies, out of an emergency room so that their companies don't die. But it's weird, It's literally looking at your customers as entrepreneurs. It's building solutions to the problems that they have. And it's really, we've crafted something of a services company, and we've built a portfolio now of 55 companies over the last 5 years where we've helped them with. Those companies are now worth about $600 million. They've raised about $100 million. We've had 8 acquisitions from our portfolio of 55 companies. And the model works. It turns out that helping companies to not die, they tend to live. And startups that live tend to grow. It's either binary, you're either dying or you're growing quickly as a software startup. And once you can flip that switch into the grow quickly phase, it tends to do actually quite well. So does that answer your question? How did you build that network? That's a long
no
way to
idea
go,
what
man.
the question was. You were on a roll. I wanted to cut you off and reference all of the Jesus metaphors, the beard, the hair, everything, but decided not to do it. But it sounds like water to wine right here. So
Yeah.
you're building this. You decide to launch a fund. What does that look like? How does someone who is a nurse within a network launch a fund?
So my core problems have been, look, startups looking for help. I have 99 problems. Deal flow ain't one. I have 10 startups a day reach out to me through LinkedIn social media saying, hey, I need this. Hey, I'm raising money. Hey, I did this. So I learned quickly that we could actually get advisory stakes in companies very easily. My challenge was going to be paying my rent. I didn't want to have to wipe butts and save lives for a living for the rest of my life. So how do I essentially turn some of this equity into rent? So I became something of a financial engineer. What we've done the last 5 years is we've created holding companies to hold stock from anywhere from 10 to 20 companies. And we start a new one every 18 months. So we create a holding company. Our startups that we work with pay their stock into the holding company. We'll keep about a third of the holding company. The startups become part owners of the holding company as well. And then we sell off roughly half of the holding company to angel investors to pay our bills. So,
is anyone else doing something like this? I've never heard of anything like it.
No one's done it. I learned about it from The Big Short.
Oh no, we're going there.
I was just like, I'm a nerd, I'm a nurse, I have all these advisory stakes, and I read The Big Short, and I'm like, holy crap, you could put a legal wrapper around mortgages, and you can sell bundles of mortgages, and then you can build bundles of those bundles, and then slice up those bundles, and then you can slice up those. Wow, that's crazy, but no. But wait. I can put a legal wrapper around a financial thing like startup stock, and then I can sell part of that legal wrapper. How do I do that? I talked with 6 law firms in Silicon Valley. I got laughed at by a couple. One of the lawyers looked at me and said, it was a fund lawyer from a major law firm in Silicon Valley. And he looked at me and said, this is the stupidest fucking idea I've ever fucking heard. Like, just straight up to my face. And I was like, why is he being so hostile? Okay. Why? Oh, maybe he's just used to kind of like big, somewhat arrogant, as they say in New York, big swinging dick fund managers. So I'm like, well, let me kind of put my, BSD kind of hat on. And so I went back to him and I said, why am I doing this? Because I fucking can. And I'm going to own seed stage in Silicon Valley because everyone who fucking comes to town comes to my events, and I'm going to be able to cherry pick the best companies. I'm going to do this. I'm going to get stock. I'm going to do this. And, in 5 years, I'm going to do the same thing for Series A, and I'm going to get companies to give me 20% of their stock. It's going to go into one fund. I can then go to a rich family and say, give me one $30 million check. I'm going to split it up amongst 10 companies or 20 companies, and I'm going to kick venture capital, Series A venture capital in the balls. So if you want to innovate and make some money, let's talk. And at the end of the conversation, the lawyer was like, oh, Mr. Nelson, this is fantastic. Absolutely. How do we collaborate and innovate together?
Kiss-ass lawyers.
I was like, you asshole. So I fired him. But
so interesting. So the concept, I understand for your advisory role, let's say you have X%, typically somewhere between a quarter and a point. It might be slightly higher based off of what you guys are doing.
Yeah, so we've taken anywhere from a quarter to 5% of the companies, depending on the work involved. Right now, our standard deal is 3 to 5%. It's not 3 months and you're out. We are in it for the life of the company, and I have a staff of 18 people in 3 different countries to support you at this point in time.
And you get investors who are also customers because they're buying your ownership. they're buying it at a discount, obviously, because it's not
Yep.
like the future is realized.
Yep.
So what do the multiples look like for that? Let's say I want to invest and you've got 20 companies. How in God's name are you pricing that?
So when the fund is empty and I'm promising 20 companies, the average seed stage valuation of a company is about $5 million. If you look at angel.co/valuations, that's just kind of what the market is. So I say, look, I'm going to bring you 20 companies. I'm going to get 3 to 5% of these 20 companies. Let's pretend every company is going to be worth $2.5 million, or half of what a seed stage valuation is going to be. And then I have 1 million shares. And so 5% of 20 companies, valued at $2.5 million, that gives me roughly a valuation of this empty fund. And I can say, look, I will sell you, these shares at $2.50 a piece. Part of this company at $2.50 per share. I have 1 million shares in this holding company. And then as we start bringing startups in, the startups raise money and their equity gets priced. And so the average value
you're pre-selling them.
So I'm pre-selling, and then I'm also doing a rolling close. And so the last company that we just brought on board is one of the largest smart building companies in Latin America. They have 80 employees. They're going to do $2 to $3 million a year. This business, $2 to $3 million in business this year. So we got a significant percentage of that company. But my investors essentially bought the piece of stock in that company that I'm selling them as if that company's worth $2.5 million. That company is doing $2 million of business this year. So they get a huge discount. I have a lot of margin to work with. And so I've been doing about 30% a year for my investors over the last 5 years running.
So it's like a pseudo secondaries fund / market.
Yeah. I mean, it's a way for me to get secondary liquidity on this pool of equity that I'm able to get.
Interesting. So you're selling before having the startup. So it's not like, here's a batch of companies and we're going to sell. It's not like packaging the mortgages and seeing the mortgages. It's anticipating what's going to come and investing in. So it is traditionally more like a fund than it is like a secondary, but still, it's very interesting.
And I mean, it took me about 2 years to actually develop the model and conversations with a bunch of law firms. And Naval at AngelList was actually quite helpful in kind of helping us think through this model. It's similar to an AngelList syndicate in terms of the legal structure. It's just backwards. An AngelList syndicate, you create one holding company around buying stock in a startup, and then you bring a bunch of angel investors to it. We actually bring a bunch of startups to our holding company, and then we actually sell off pieces of the SPV to angel investors.
That's very interesting. Okay.
It's actually it's the only way, in my opinion, it's the only way that an accelerator, quote unquote, or incubator model will actually work financially over the long term, because the 2 and 20 model of a standard fund doesn't work for like sub $20 million funds.
For accelerators, it's easier because they're essentially indexing the market. So as long as the market's going up, they're going to be successful. Now, let's say you're running an accelerator. You have 2 options. Either you keep raising larger and larger funds to have follow-on funds, or you expand to other markets. The other markets one eventually runs out, because if everyone's expanding to other markets, you get into an Uber situation where it's a price war. But
the one of the problems in terms of the 2 and 20 model is the 2% management fee.
It's nothing.
It's nothing if I'm running an accelerator. A $10 million fund, I have $200,000 a year as an operating budget. Like, I can't, live in Silicon Valley and pay rent for an office.
But let's say
$200,000.
That's what you start with. Then you're building up the carry. So obviously you're not making money on the fees initially. But if you keep raising subsequent larger funds to reinvest as opportunity funds in the past companies, it can work. I've seen it work really well, but It's very interesting, the model that you're doing. So I imagine you've had a lot of backlash on this.
It has been a heavy enterprise sales process on this. We have not been a fit for traditional venture funds at all. The first time around, when I talked with a lot of VCs in Silicon Valley, I was still working as a nurse, and they're like, "Oh, cute! The nurse is building an accelerator. Great. This market sucks. It's a total bubble." Some of them have changed their minds now when they've actually seen what we've been able to accomplish. We have, very good friends who are VCs who've been very helpful. But, I'm also fairly agnostic in terms of the types of capital that my startups raise. So I have a long conversation with our entrepreneurs and I say, what kind of company do you want to build? Frankly, if you want to bootstrap your company and if you want to sell for 7 or 8 figures, that's a great little exit for us. And my investors make money, I make money, and everybody makes money with a 7-figure exit with my model, because
there's no
everybody just gets a dividend.
Yeah.
I don't get a carry. I have 300,000 shares out of 1 million in my SPV. My investors have anywhere from 5,000 shares to 100,000 shares of this SPV. And so we essentially issue a dividend on every exit.
And because there's no carry, you don't have to play the game where it has to be a home run every time. And because
Correct.
There's no management fees, you're not really incentivized to make it larger other than having more to. So you are incentivized, but in a different way.
Correct.
It's interesting. So what are the challenges that you've had thus far outside of convincing others that this is something?
Convincing others that this is something has been a challenge. Another challenge has been, we just decided to have a blind selection process. So we remove people's names, genders, ages, schools they went to from the application process. I speak Spanish fluently. 2/3 of our portfolio companies have a woman, an African American, or Hispanic founder on the founding team. If you look at the ratio of startups in Silicon Valley that get venture funded that have a woman, it's 4%, African American, 1%, Hispanic, 1%. So I believe that I probably have one of the most diverse portfolios in Silicon Valley. And I'm really kind of tired of trying to push a ball uphill in terms of getting some of these entrepreneurs funded.
Do you know Arlen Hamilton?
What's that?
You know Arlen Hamilton?
Mm-mm.
So she runs, what's the name of it? Bootstrap VC. It's a podcast, and she's also runs a venture firm as well, essentially investing solely in underrepresented founders. So you have to hit one of those 3 criteria for her to invest. I know there are some investors that are doing it, but it's definitely less than you would like. It's hard to, and I mean, you can understand from both sides. People don't want to say we have to do this because then it's like,
is this an affirmative action founder?
Yeah, it just creates problems when you say you have to do something. I like the way you're doing it and that you're filtering out the biases by just not having the information. Then it just happens organically. And because, let's face it, I imagine your network is significantly more international than most because you accidentally spread the plague of startups across the world.
No, that's pretty much it. And so, I'm doing a lot of work with Latin American startups, and less than 1% of venture funded startups are Hispanic. And so my startups just don't fit the traditional pattern match in Silicon Valley. So we've actually been doing a lot of investor education with angels and family offices in Latin America, teaching them how to actually think of entrepreneurs as an asset class and thinking of how you can actually build wealth by investing in portfolios of startups. The pushback that I've gotten from them is, how do I get my money back out? And then you're like, well, Google acquires them, or they IPO. And they're like, wait, El Google? No. El Google is not going to come to Guadalajara and acquire a startup. Or, how many companies from NASDAQ have IPO'd on the NASDAQ from Latin America in the last 20 years? 2. So their level of belief is actually quite low. And it all comes down to this fundamental liquidity problem. My personal problem has been, how do I get secondary liquidity on my stock? The venture capitalists and angels in emerging markets have a really hard time because of liquidity. And so I spent 2 years on this SEC committee, and we were looking at crowdfunding and why so much capital gets invested in Silicon Valley, as well as, the capital tends to aggregate into startups on the coast. And in the middle of the country, venture capital is almost non-existent. And so why is that? Well, when you look at it, it's because 85% of the world's technology mergers and acquisitions happen in Silicon Valley. So investors make money when there's a technology acquisition, and 85% of those happen in Silicon Valley, which is why 2/3 of all of the world's venture capital and angel money gets invested in Silicon Valley. And so there's liquidity in Silicon Valley, and capital follows liquidity over the long term. And so my obsession has been this problem of liquidity. How can we, as investors, essentially, is there a way for me to bring my own liquidity to the table so I don't have to expect my portfolio companies to give me the liquidity that I need for my business? And I did a bunch of research on what it would mean to take a venture fund public. You need a liquid market for stock. You have to kind of think about the public markets in the United States. What it would cost to take a venture fund public is you'd have to use a very obscure legal structure called a business development company. The lawyers who have done the handful of those legal structures in this country over the last 20 years are extremely expensive. You're talking several $1,000s an hour. And it would essentially cost me $5 million to create a fund and to let it trade on the NASDAQ. And it would cost me $2 to $2.5 million a year just in legal and accounting maintenance. And I literally had a phone call with a lawyer in New York City, because this isn't a Silicon Valley thing, like publicly traded funds are a New York thing. And so this lawyer is like, I'm sorry if, it's a little noisy. I'm standing on the deck of my yacht. Hey, Raul, give me some more Chablis, would you please? Sorry, Mr. Nelson, you were saying you wanted to take a fund public. Oh, no. You can't even afford to think about it unless you're going to be managing $500 million or more. No, the management fees are just way, I'm going to charge you $5 million just to build this fund. And I'm like, okay.
There is a UK-based one, I know. Yes.
So London and the London Stock Exchange has a little bit less rules. We've talked a lot with the London Stock Exchange. Ironically, I'm still seen as a first-time fund manager because I essentially haven't invested other people's money. I've invested blood, sweat, and tears. So even though I've been doing 30% year over year for my investors for 5 years running and kicking the crap out of the performance of the industry, I have to still kind of prove myself. So eventually, being hackers and founders, I'm kvetching about this at a bar over beer with my friends. And they're like, dude, you're overthinking this. You need to just do this on the blockchain. And I'm like, what? Well, I don't know. Legal securities laws. So I did a year of deep dive on the legal and regulatory. And the technical implementation is actually quite easy. I just use blockchain stock certificates. Instead of creating a coin, I'm creating a stock. And I have this stock represent, ownership in my fund. And now my stock, because it's crypto, trades on crypto exchanges. And so I have built a liquid venture fund where people can buy, sell, and trade the stock in my fund on offshore exchanges. And so my job as a fund manager of a liquid fund is fundamentally different. In a venture fund, a traditional venture model, my job is I need to pick companies that have a decent chance of my flipping them to Google within 10 years for $500 million. Or I need to try to figure out which companies have the potential to IPO in a decade. And that's the game. You know, angels, the game is a little bit different. The game is, how do I invest in companies that I think are going to get acquired and I can make a 2 to 3x multiple within a couple of years. But if you actually have a fund that's liquid, my fund investors buy my stock and they want my stock to increase in value. How do I help that happen? I need to invest in companies that are increasing in value, and I need to be able to measure that increase in value and prove that increase in value. eShares, they just changed their name to Carta, but eShares has that product.
Why did they change their name? Oh, they had such a good track record.
Yeah, they had, I think there was a trademark conflict. And so if you Googled eShares, there were like 3 different companies that popped up. But for $250 a year, I can essentially input some data on my portfolio company, and that will essentially pump out a valuation. They make it really easy for me to bundle my whole portfolio, have those valuations audited. And so now, for very cheaply, I can, on a quarterly basis, provide a net asset value of what my stock in all of my companies is actually worth. And I can report this as if this were a publicly traded fund and I were reporting it to the SEC. I can just report this on my website. I can put this on a blockchain so that you know that I'm not screwing with the numbers. I have a top-tier accounting firm audit this so that you know that I'm not juking the stats. And now I have a way where I can prove that my portfolio is growing or shrinking in value, and my investors in my fund can buy, sell, and trade my stock as if it were a mutual fund or as if it were an ETF. And so I believe that liquid funds are fundamentally going to change, and blockchain, because it's just crazy easy technically to actually do this, that blockchain-based venture funds are going to completely change the landscape when it comes to venture capital. And honestly, at this point, I don't care about liquidity for my portfolio companies. My companies don't have to be in Silicon Valley. They can be in Peoria. All I need them to do is to grow in value, and I need to be able to measure and prove that growth in value. They can be in Bucharest, they can be in Zurich, they can be in Buenos Aires. I just need to be able to measure and provably audit their growth and value, and I need to be able to report that. And so a portfolio company that grows 30 or 50% year over year, that's a fantastic investment for me. Whereas in a standard venture model, if you're not growing 20% month over month, you're not going to hit that escape velocity, which means that you would be able to IPO or become worth $500 million within 10 years. So I can actually invest in profitable companies. I can invest in revenue-producing companies. My fund is actually going to be much more founder-friendly, because if you want to go quick in IPO, that's fantastic. If you want to grow 50%, 100% year over year, that's fantastic. Like, let's help you grow as fast as you can, but let's do what's right for the company and not what's right for the VC. And so if we do this right, if I don't screw this up, I think we change how venture capital works, and I think we grow entire economies, which is just kind of fun.
I'm fascinated by the blockchain space,
Yep.
but I've heard this argument a lot of times, at least in terms of taking a fund onto the blockchain. And the biggest problem I see is liquidity is great, but it's also terrible. So the reason why you don't see publicly traded companies making big bets and changing the world is because they have a gun to their head, which is Wall Street. And if they aren't hitting the numbers, then investors are going to flip the stocks. The stock prices go down. We get a new CEO. That's the biggest challenge I see, is that liquidity leads to short-term easy liquidity leads to short-term thinking.
Yep. No, you're absolutely right. And that's a fantastic insight. I believe that we also need new types of exchanges. When you look at the history of stock and the history of stock exchanges, they started by a bunch of people in Amsterdam getting together underneath an oak tree, and a bunch of people in London getting underneath it on a bench in a tree. And they would sit there and they would kvetch and talk about, is this ship that we all invested in, what's the latest rumors that you actually heard? You know, how have the other ships that have come back from the New World create, you know, bringing spices or, you know, slaves or whatever, how are they doing? And they would essentially make bets based on this news, and they would buy and sell and trade their stock. Well, it only made sense to do this once a month or once every couple of months. But then the volume of these transactions started to increase. And so people started to get together more and more often. But I think what we need to do is, I think that we need to have exchanges where the stock in thinly traded stocks is traded once a quarter. And it's auctioned off once a quarter. If you want to sell, you throw your stock into the auction. If you want to buy, you buy at the auction. And you can use a reverse Dutch auction. And I, as a stock seller, as a stock owner, I should be able to say, I want my stock traded once a quarter or once a month or once a week or once a day, instead of being forced to have my stock traded 24/7. And I think when we build an exchange like that, I think that we can actually start to teach the investors a bit more longer term thinking about investing in companies over years, instead of thinking about what's my latest quarterly profit and do I need to pump and dump this sort of stuff.
Eric Ries is working on this, to my understanding, long-term stock exchange.
Yep. And I, you know, my grand plan is a liquid fund, is early liquidity for portfolio companies, tokenize their stock, take them to ICO rather than do a Series B level round where they need $10 to $20 million. And then step 3 that you have to add is build an exchange where I can actually determine how often I want my stock traded as an entrepreneur, or as the board of the company. They need to be able to set, I want my stock to be traded once a quarter, and concentrate all the buyers and all the sellers at one point in time, so that you avoid these massive swings and price fluctuations that you have with penny stocks.
Yeah, the speed is the big problem, because speed creates volatility. It would be interesting to see some economists and game theorists break this down. I feel like there's definite benefits, although companies that wanted to have a longer term time horizon would realize that they were essentially shooting themselves in the head, and that Wall Street wouldn't play those games.
Yeah, and I mean, the disadvantage is that Wall Street is a very, very well-established industry, and things work very, very well for Wall Street because it's primarily based on transaction fees.
Yeah.
But I don't think Wall Street works as well for
anyone else,
the pensioners, for the limited partners, for the angels that are actively investing in these assets. And so I think that blockchain gives us an opportunity to essentially reimagine what some of these financial products should actually look like. And that's frankly what we're doing. I'm reimagining what a venture fund would actually look like, being completely liquid. And, you know, there's risk associated with it. At the same time, you shouldn't be invested in venture if you're not interested in risk. You know, I'm personally just kind of very risk on. I will acquire as much risk as I can, while limiting my
uncertainty.
downside. What's that?
So I heard a fascinating argument. It's not risk that builds real wealth. It's uncertainty. because when it's risk, anyone can quantify the pros and cons, the probabilities. That's what risk means. The reason why uncertainty is so seductive in terms of returns is it's something that anyone that's risk averse avoids because you're not able to put your finger on it. And by being not able to put your finger on it, that means you're focused on building something new, innovative. And it's making a new pie versus trying to steal a piece of someone else's pizza.
That's actually interesting. No, I like that. I actually really like that. But, this is why I'm kind of all in on this whole blockchain space. I started off quite skeptical, but I have to say I drank the Kool-Aid, and now I'm a believer of the techno religion. And, money's kind of a religion. It works because we believe. Stock is kind of a religion. It works because we believe. And I'm a believer in blockchain, and I know enough of the alpha geeks in my community are all in. And one of the things that I've learned after 10 years of hanging around with entrepreneurs, being hackers and founders, we get some crazy smart people at our events, is if they show me something and I nerdgasm about it, in 4 or 5 years, it usually becomes a thing. If I'm like, oh my God, that's so cool. At this point in time, the nerds are all saying, oh my God, this is so cool about blockchain. So it's a thing. I think the volatility in terms of crypto prices has been something of a red herring. It's gotten great media exposure because of it. But at the same time, I think the real future for blockchain is in using the technologies, for instance, like what I'm doing, to tokenize real assets. You're going to be able to have tokenized venture funds, tokenized real estate funds, tokenized gold, tokenized power. Yeah. Tokenized privacy. You're going to be able to essentially tokenize and trade almost any asset that can be tokenizable, in my mind, will be tokenizable over the long term. And, that's one of the reasons why I kind of all in. The other reason is that it's going to cost me a total of, a couple $100,000 to get this fund off the ground, as opposed to $5 million. And my maintenance is going to be a couple $100,000 a year, as opposed to $2 million.
Plus, it's more exciting because no one else is really. I guess there's a couple of funds that have done it, but at the same time, it's breaking new ground versus playing on an old playground.
Yeah, and I mean, I knew what venture looked like, and if I became kind of a traditional venture capitalist, I was like, yawn. But something like this was actually quite interesting. And I don't necessarily think that the future of these is in the United States. I'm focusing a lot on emerging markets. And emerging markets desperately need the liquidity.
Especially now that all the U.S. money is coming back to the U.S.
Oh, yeah.
They no longer have to buy offshore.
Yep. Money's flowing back into the United States, is flowing back into Europe. And emerging markets have just kind of traditionally been capital starved. And I think that the reason that they're capital starved is because of a fundamental lack of liquidity. And so what if we can actually bring liquidity to these markets? Daily trading volume of Bitcoin is larger than the quarterly trading volume of the entire Chilean stock exchange.
That's it doesn't make a lot of sense to have a different stock exchange in different cities and countries.
No, you need to have regional, multinational exchanges based on tokenized stocks. And for instance, you need the NASDAQ for the Spanish-speaking world. You should have tokenized stock. And for 25 countries, they should have one stock exchange. Let's build it in the Cayman Islands. Let's build it, find one jurisdiction that'll actually do this.
Singapore.
Yeah.
It's always Singapore.
And then let's move forward and build a regional exchange and start connecting these small emerging countries with global crypto capital markets.
So I want to get into the lightning round in a sec, but first, what's up with the White House and Bloomberg?
The White House and Bloomberg. Double click.
I hear that you had a bit of a background with them. You worked that I don't remember. I was looking
Oh,
into your
so
bio
immigration. Yeah, no. So I got sick of seeing my entrepreneurs deported. Um, I
before
got
or
sick
after
of
Trump.
this was Obama administration.
Okay.
So a friend of mine, Craig Montori, he was a Caltech aerospace engineer, and he's like, Jonathan, I don't want to be an engineer. I want to be a politician. Is there anything in startup land that I can fix for entrepreneurs in policy and government? I'm like, yeah, immigration. He's like, okay, I'm going to fix immigration. I'm like, you go, Craig. So he gets his master's in public policy. He gets asked to write a paper on immigration policy. And his paper is, we need to change the discussion on immigration from border fences and or civil rights to that of economic growth. And we need to get the entrepreneurs and the job creators in this country. We need to create a startup visa. We need to create. So he gave that to his friends. It crossed Obama's desk. 3 days later, I'm talking with with Doug Rand, the head staffer in entrepreneurship and immigration for the White House, the Obama administration. And I'm working as a nurse. I'm like, hi, Doug, how can I help you? He's like, Craig tells me that you have something interesting to say on immigration. I'm like, oh, well, if you fix it, you'll have thousands of companies move to the United States. And I think that you fix the economy. What? What do you mean thousands of companies moving to the United States? I'm like, yeah, dude. Like, there's this huge explosion worldwide of companies trying to get tech companies. The only place they can raise money is in Silicon Valley in the United States. Fix immigration, and you will have a giant flood of tech companies move to the United States. He's like, wait, like, how many am I talking about? And I'm like, tens of thousands. Like, this is my global network of tech entrepreneurs. I'm guessing a third of them would like to come to the United States and build their company in Silicon Valley or the US. He's like, no, is there anybody else that I can talk to this? Because I talked to Sequoia and they need like 8 visas for their portfolio. And Andreessen Horowitz needs 10. And Microsoft wants cheap engineers. But I haven't heard anybody say that there's thousands of entrepreneurs interested in coming to this country. And I'm like, have you met Naval? No. Have you met Dave McClure? No. So 2 weeks later, I was showing 2 White House staffers around Silicon Valley. And I worked at the hospital that weekend. I get invited to an immigration summit that the Obama administration puts together. They created a program called the Entrepreneur in Residence Program inside of USCIS to identify why are entrepreneurs getting deported. Why are these people raising several $1 million, having employees in the United States, and then getting kicked out of the country? It turns out that during the Bush administration, the big mandate in USCIS was we have to keep the terrorists out. So what does a terrorist look like? I don't know. They have a beard, they have a backpack, a laptop, and they go around saying, no, I have a company, right. And so a lot of these entrepreneurs were essentially being flagged as fraudulent applications, and they were either being stopped at the border, prevented from getting in, or once they were in the United States, the adjudicators for immigration would kick them out. So Mayor Bloomberg's office was also actually quite active in this. So we worked with the White House and Mayor Bloomberg's office on both comprehensive immigration reform, but specifically on entrepreneur immigration. And we almost got a startup visa across the line. Obama administration wanted this as kind of the cherry on top for comprehensive immigration reform. Congress wouldn't pass it. So 2 months before the Obama administration ended, they passed I believe it was going to be what they called an entrepreneur parole, or a category visa, which is essentially be a startup visa. Texas took it to the Supreme Court, so that got shut down. But we've been working on immigration. Fuck Texas. No, not Texas. But now during the Trump administration, it's just been
it's all gone to shit.
Yeah, it's just a shit show. And so what we did do is there's a program called Entrepreneurs in Residence that Craig spun out. There is a category of H-1B visas, which is uncapped, which is research fellowships at universities. So Craig created an entrepreneurship research fellowship at 6 different universities in 6 different states. And so entrepreneurs come. It's called an entrepreneur in residence. They go to a university. They get a rubber stamped H-1B for 3 years, and our first 40 visas have 100% approval rating. It's a nonprofit. It's called globaleir.org. If you guys are interested in supporting it, they could use a bit of fundraising. So I always like to pimp them out. But that's the story between Bloomberg and the White House and Hackerson Founders.
Nitin is doing something similar. Nitin Pachia with Unshackled VC. Basically,
Yes.
work with exclusively immigrant founders dealing with various. It's I don't. Let's not even get into it. That's just a.
That's another podcast.
Let's make America great again. So let's jump to the lightning round. How's that sound?
Bring it.
First deal you ever did?
First deal I ever did.
I guess this would be more advisory.
Advisory, browserling.com. One of the founders got drunk, tripped his head, cut his head, went to the emergency room, ended up spending $20,000 and said, Jonathan, can you help me raise some money? Because I don't have any money left. That was all my runway. Otherwise, I have to go back to Latvia. So that was browserling.com. That was the first startup into our co-op portfolio. We're finally getting them a visa to come back. They're profitable. They do online web testing. Pateris is an amazing founder and fantastic to work with him.
What are you excited about today?
Every asset that can be tokenized will be tokenized. Crypto and the opportunity to remake the financial industry and to reshape it. Hopefully, make it better. There's going to be a lot of challenges in that, but I'm deep into the whole crypto space right now.
2 biggest wins to date.
2 biggest wins, tripping.com. They publicly acknowledge that they're going to do about $400 million in business this year, or at least that was last year. So their last valuation was over $300 million. Their second biggest win, I would say, is our move into blockchain and crypto. I'm really excited about it, and I really think it's got a lot of upside.
It's pretty awesome. What about big misses? Anti-portfolio.
Anti-portfolio. It was hard because it was an advisory. There's a company called WePay. They just got acquired, I believe, by JP Morgan for an undisclosed, 9-figure exit. But they came to our events the night that they interviewed for Y Combinator. And I'm like, hey, how can I help? And they're like, hey, can you transfer some money using our system? Can you give me your bank account? So I did. I believe I was actually the first person to give them my bank account information so they could transfer money. I transferred like $2 using WePay. I've been friends with Rich for years, and now they're, 9-figure exits. So had I had a fund, I could have been a contender.
It happens. It happens.
That's the deal.
If I give you one question to ask a founder before you decide to work with them or invest, what would it be?
Who's your customer? And how do you get paid?
I like it. 1-2 punch.
Yep.
What blogs, podcasts, resources, etc. do you go to daily, weekly basis to stay informed?
I have a network of subreddits that I actually read. I do our programming, our crypto, our Bitcoin, our business, our economy, our economics, our startups, our hardware startups, our robotics.
Big Reddit.
So I read about an hour or 2 a day.
Okay. What would you say is overhyped other than ICOs? Nothing wrong with the one you guys are doing, but in general.
In general, overhyped. 2 and 20. The standard venture fund model. I can't figure out why it's still working. I think it's just everybody says that it's the way to do things, and I just can't wrap my mind around it. I think it underperforms. Just structurally, it underperforms what angels actually do, and what we've been able to do.
Angels are always a little bit better, typically just because they're a little bit earlier, but not significantly. That's the stats I've seen.
And Kauffman Foundation put out a study. If an angel can build a portfolio of 20 to 25 companies, they tend to do 25% a year. Venture as an asset class does 5% a year.
Oh, I've seen very different stats on that. I'd
love to see them.
Oh, who sent it to me? It was something like angels being 30. I think it depends on your time frame as well. It was something like over the past 20 or 30 years, angels were 30 plus and VCs were 2 or 3 points behind that on
interesting.
Like a Series A VC. But I don't have the stats, so I don't know if that's correct or not.
If you come across them, I'd love to read them because I'm a big data-driven kind of guy. So if I'm wrong, I want to see the data.
Perfect. I will do that. What's something we haven't talked about yet that you want to bring up before we hop off?
The influence of open source and economic growth.
I like it. A hacker to the end.
That's it.
Where's the best place for people to say hey?
hf.cx is our website. If you want to reach out to me through LinkedIn, Jonathan Nelson. I'm actually quite active there, and that's really kind of the only social network that I really spend a lot of time on these days. Twitter @IMLGringo. I check it a couple of times a week, but reach out through LinkedIn, Jonathan Nelson.
Makes sense, the gringo thing now. So you grew up in Central and South America. It makes sense now.
That's it.
I was very curious about that for a sec. What before we jump off, so ICO, what are you guys trying to raise? I know this is not a public offering. I'm in no way, shape, or form doing anything of recommendation. Just curious.
No, absolutely. So we have room for 99 US accredited investors, and I can talk about that publicly. Unaccredited investors in the United States, you're screwed. Sorry, you cannot participate. Unaccredited investors in the United States, outside of the United States, the SEC doesn't care, and I can take people investing as low as $1. So if you go to hf.cx, it will soon be hackfund.com. But if you go to hack.hf.cx, you can kind of look at what we're doing. We haven't disclosed how much we're raising in total. I will make 30 investments for every $10 million, at least 30 investments for every $10 million raised. And so, I have a hard cap in my mind, but if I tell you that I want to raise, $500 million and I raise, $80 million, it's perceived as a big failure. Whereas if I tell you I'm raising $5 million and I raise 80, then I'm perceived as greedy. So we're not out and out telling how much people we actually want to raise just to avoid that whole discussion.
It's funny because my background is crowdfunding, and that dynamic never came in. So you always wanted to undershoot so that you could way blow it away, but it had nothing to do with greed. It had to do with just being incredibly amazing. It's interesting that doesn't completely apply here, but I guess typically in Kickstarter you need a shit ton of money to do hardware. Guys, check it out. Check out hf.cx. We'll throw links to everything in the show notes. And speaking of accredited investors, if you are accredited, the syndicate.vc/join. You can check out our syndicate, look at our deal flow. We've got some deals coming up, and invest alongside us. Thanks for coming on today. It was really fun, Jonathan.
I really appreciate it, Matt. Thank you so much for having me. It's great talking.
Beard.
Yes.
Yes, yours dominates mine. Until next time, guys. Cheers. This is us signing out.